Welcome back. My name is Hiram John, and today we'll be talking about choosing the right entity form for your family office. In part one and part two, we saw why Korean H&W families favor Singapore and reviewed tax schemes based on sections 31, 13U, and 13OA. Now in part three, we tackle entity forms such as private limited company, limited liability partnerships, limited partnerships, and variable capital company. So think of these as different legal containers for your family office. The key insight is that corporate versus partnership versus fund forms lead to very different tax outcomes and risks. We'll compare each form's structure, tax treatment, and liability profile. First, let's look into private limited company. A Singapore private limited company is the most common vehicle. It's a company limited by shares, which means it's a standalone legal person with perpetual existence. For tax, the company itself pays 17% on income. Then any distributions, dividends to you are tax exempt. In practice, this makes things straightforward. Profits are taxed once, and you can take out cash without a second tax hit. We often see family holding companies and family office managers set up as private limited companies. Well, the drawback is that a company is formal. So you need local resident directors, audited accounts, unless small, and regular filings. But for a large family office, the benefits, for limited liability and clarity, often outweigh the costs. Also, private limited companies can operate the investment fund under schemes like Section 13O, 13U if you hire a MAS licensed fund manager. In short, private limited company offers tax predictability, flat rate, no surprise pass-through, and strong liability protection. Now let's move on to limited liability partnerships, which we also call as LLP. An LLP gives you the best of both worlds, limited liability and partnership flexibility. It's legally a separate body corporate, so it can hold assets under its name, but it operates like a partnership. Critically, Singapore tax treats an LLP like a pass-through entity. The LLP pays no tax itself. Instead, each partner reports his or her share of profit. For example, if you and your partner each own 50% of an LLP that earns 1 million, each reports 500K on your tax returns. An individual partner might end up paying, say, 15% personal tax on 500K, whereas a company partner pays the 17% corporate rate on its share. This pass-through can be a tax feature or bug depending on your situation. In some cases, some families assume no company tax means tax avoidance, but actually it just shifts the tax burden to the owners. Also, an LLP can't itself sign up for MAS fund incentives. If you want Section 13O and 13U, you would need a separate licensed corporate fund manager. The LLP alone won't qualify. But on the plus side, compliance is quite light. No mandatory audit or fancy share structure. In short, an LLP is great for operational flexibility, but profits are instantly taxable in the partner's hand. Now let's look at the limited partnership. Limited partnerships are familiar from private equity and venture funds. You said one partner as the go-to manager, the GP, the general partner, and others as passive investors, LPs, which is limited partners. Because an LP is not its own corporation, it can't, for example, own property in its own name. But tax-wise, it resembles an LLP. Each partner individually declares their share of profits. Under the 2024 tax law changes, Singapore is even allowing LPs to apply for a tax exemption on qualifying returns. In practical terms, this means a small family fund organized as a limited partnership, say for private equity or family businesses, can get the same kind of tax break that a corporate fund under 13.0 would enjoy. That's a great deal, actually. But the catch here is that the general partner remains fully on the hook for debts. Many families address this by making the general partner itself a private limited company. So the company has liability instead of a person. But remember that profit sharing is flexible. You can match distributions to each partner's contribution. So in summary, a limited partnership gives flexibility and sometimes with 13.0A, also potential tax breaks. But you must manage that unlimited liability general partner. Now let's move on to variable capital company, which we can shorten as VCC. The VCC is Singapore's most flexible fund wrapper. Think of it as a company built or investment funds. It has all the corporate benefits, limited liability, separate entity status, but adds fund features. For example, you can create an umbrella VCC with sub-funds. So each sub-fund's assets and liabilities are ring-fenced from the others. This is a huge boon for risk management. A bad investment in one sub-fund cannot drag down the rest. Unlike a normal company, a VCC can redeem shares easily and even pay distributions out of capital, which gives liquidity for investors. Tax-wise, a VCC is treated just like a Singapore company. It pays 17% corporate tax on its profits, and then distributions are tax-free. Crucially, with a licensed fund manager, a VCC can apply for the Section 13U, 13O tax exemptions just like any other fund. So you get corporate tax treatment and potential tax breaks on qualifying income. The trade-off is compliance. VCCs must have MAS-approved governance, such as a local fund manager, auditor, and etc. In practice, VCCs shine when a family office needs complex structuring or wants to pool multiple strategies under one legal roof. So to give you the key takeaways, when selecting an entity structures for your family office, you have to consider how tax treatment, liability protections, and operational flexibility align with your specific goals and investment strategies. So in short, a corporate form such as private limited company or VCC is taxed at the corporate rate and gives strongest asset protection. The only tax paid is the 17%, and creditors can only go after the company, not the shareholders. But you must maintain all companies' formalities. A partnership form such as LLP or LP has no corporate tax. You simply pay tax at the partner level. This often lowers the headline tax if partners are individuals, because individuals pay progressive rates up to 24%, possibly less than 17% at low incomes. But it also means the owners are on the hook. For example, in the LP, the GP is personally liable. But on the bright side, partners in an LLP are only liable for their own mistakes. Finally, the VCC acts like a company tax-wise, but partitions assets across sub-funds, offering both limited liability and operational efficiency for complex portfolios. So in conclusion, there's actually no one-size-fits-all answer. As I mentioned, you must align the entity form with your priorities. Tax efficiency versus operational flexibility versus liability concerns. In many cases, many initially lean toward a simple LLP for flexibility, only to find out, often to their surprise, that LLPs have no corporate tax shield. Every profit dollar flows straight to their personal tax return. Others default to private limited company because it's familiar until we run the numbers and see that, for example, an individual partner would pay more tax personally than the company would. Interestingly, Singapore keeps tweaking the rules. For example, the extension of fund incentives to limited partnerships, Section 1308, caught some family off guard. Now, even smaller PEs, VC styles funds using an LP can enjoy tax exemptions. That illustrates the point. We need to watch regulatory changes carefully. Who would have thought in 2025 that an LP could get a 13-0 like break, right? So one insight that I would like to share here is that tax savings should never trump common sense. In one case, a family loved the idea of a VCC for its privacy and asset segregation, but ultimately they had a single simple portfolio. In that case, we can decide a plain private limited company, a private limited, as an efficient form because it's simpler to operate and enough tax saving given their situation. So in summary, we need to choose corporate, private limited, or VCC if you want a formal structure, easy liability protection, and straightforward 70% taxation, and the ability to tap 13O or 13U. You choose partnership, LLP or LP, if you want partnership style flexibility and don't mind profits being taxed in partner's hand. Each path has trade-offs. My final piece of advice, do the math and plan for the long term. The right structure will evolve with your family's needs, but understanding these fundamentals helps ensure you maximize tax and efficiency while managing risk. So keep an eye on Singapore's evolving rules like BEPS 2.0 or any new incentives and adapt your structure as needed. After all, preserving family wealth is the ultimate goal. Thank you for listening.